Okay, welcome to this video. This is part 2 of my Elliot Wave appraisal of the USDZAR exchange rate. Now, there's been a lot of excitement about what's happening with the Rand recovery, whether it's Rand strength or dollar weakness, and a lot of theories going on. Twitter has been abuzz. So I came across a tweet today, an old tweet by Magnus Haystack, which I will allude to later on, and it just prompted me to make this video as a follow-up to a video I had made last year, which I had shared with a couple of people within my inner circle. And so let's take a look at this chart. What I have here is the dollar rand exchange rate going as far back as 1972. And I won't go through this whole wave count. I went through this in great detail in the first video. But let's just recap why I prefer the Elliott Wave principle so much. So the Elliott Wave principle helps us to identify the trend. It identifies counter trend moves within the trend. It confirms the resumption of the trend, identifies the maturity of the trend, and this can be explained best when you refer back to the first video. The exchange rate was in this leg. I think it was about 18 Rand to the dollar right here. And I said in conclusion that based on this wave count, we are at or very close to the peak of this current trend. And I said that because I could see we were in the fifth wave of the fifth wave, which signals that the trend is almost at an end. It identifies the termination of the trend, provides high probability price objectives, provides specific points where the forecast is invalidated. And I believe this is one of the most important characteristics of the Elliott Wave principle. It's the only methodology I know where you know at specific price points your analysis or forecast is wrong. Fundamental analysis will not give you that. Quantitative analysis certainly will not give you that. So let's look at a number of academic or theoretical ways which you can forecast currencies. I won't go into it in detail, but just a brief overview. So this is the implied purchasing power parity, and this highlights the PPP for the rand versus the dollar throughout the years. And to a lesser degree, we use the relative economic strength, where we're basically looking at economic growth and interest rates. And the most popular one is econometric modeling, which really looks at factors affecting exchange rates. Now, this is very, very academic. You really need to have, well, maybe not say really have to have it, but most people who use these models are very, very well trained, educated in using econometrics. So most people who have, or some people that did undergrad degrees in finance and investments would have specialized in econometrics. I mean, when I did my master's in finance and investments management, I did do econometrics as one of my major modules. But beyond that, I'm more self-trained when it comes to using econometric models. So this is a basic one for the USD CAD. And we can see here, this is, like I say, it's a very simplified basic model, this one. And just looking at the factors that affect the exchange rate as per this model, we're looking at a difference in interest rates between the USA and Canada, a difference in GDP growth rates, and the difference in income growth rates. And these coefficients, A, B, and C, are estimates really, and depending on what the analyst feels, they will assign different weights to those coefficients. So even here, there's a lot of assumptions to be made as well. So it's not an exact science. So be very careful when people talk about econometric models. And because it looks very academic, it looks very advanced, and you see that maybe the analyst is a very, very highly qualified person, it does not mean that their model is correct. There are a lot of assumptions that are made, and I know many analysts who have tried forecasting exchange rates and they have failed dismally. So let's just move forward now to where we are. So since the rand peaked at just above 19 rand, we see it made a strong recovery to where it is today. And using the Elliott Wave model, I see that this recovery has been in 5 waves, and we are now currently forming this 5th wave here. So we've got this wave 1, wave 2, this wave 3 here, wave 4, wave 5, but this was for a larger degree wave 1. And then we had a very, very shallow pullback for wave 2, and we had a very, very strong move to the downside for wave 3. And typical with the Elliott Wave principle, whenever we see price action moving sideways, especially in the 4th wave, we know that we are more likely forming a triangle. And indeed, this is a triangle labeled A, B, C, D, E. And what I'm forecasting now for this 5th wave is a thrust. And using the largest portion of this triangle, which is this AB formation here, when I project this from this level at 15 Rand 10, I am forecasting that this 5th wave will likely terminate between 14 Rand and 13 Rand 50. So be careful, we may still see the Rand pull or move down lower, but I believe that this 5th wave will be very small compared to this wave 3 or this wave 1. So we could see a reversal in the short term, and that's what I'm forecasting now. A move down, but not too much, and then we will see a recovery or a rand weakening. But what does this mean? Seeing that this whole move unfolded in 5 waves, these 5 waves as a minimum is only wave A of a ABC zigzag. So I am forecasting that in the short term, we will see rand weakness. Whether it weakens back to 16 or 17, it doesn't matter as long as we don't see the rand breaking above 19 rand. And then we can expect another move to the downside for wave C. Now we can only forecast wave C once we see where wave B terminates. So that is the short-term and medium-term view. So let's see what triggered me to do this video. So today I saw this tweet by Magnus Haystack, and many people who know Magnus, he really doesn't like anything to do with South Africa. And as much as he's a very well renowned investment manager, I know he runs a wealth management company, it's not to say that everything he says it's the truth and it's going to happen. So, and this tweet was on the 10th of March, but I only saw it today. So I did respond to it, and it triggered me to make this video. So let's take a look at what this article here was all about. Just some key features or key takeaways from that article. So here's the headline: bad news for South African rand. It's not just about commodities. And this was from Bloomberg. And it says, correlation studies show rand more influenced by US yields. Okay, fair enough. Here's a major warning. Correlations are not fixed, they change. So just because at any given point in time or over the last 3 or 4 months, correlations were high or weak, it doesn't mean that in the next 3 to 4 months, it will be the same story. Correlations change. So don't just read this and think that this correlation will continue forever and ever. Rand slipped 5.5% since mid-February as Treasury yields rose. So now we're factoring in Treasury yields as part of the econometric model. So let's read what the article says. The good news for the rand is that commodity prices are hovering near an 8-year high. The bad news is that raw materials matter less for South Africa's currency than movements in US Treasury yields. The correlation between the Bloomberg Industrial Metals Sub-Index and the rand has weakened to 0.2 from a peak of 0.7 in February. So you see what I was referring to. correlations change from 0.7 to 0.2. The inverse relationship with US Treasury yields is much stronger at almost 0.6, the most in 4 years, according to data compiled by Bloomberg. So like I said, just be very careful when you read anything that refers to correlations or inverse correlations. Correlations change and no one can forecast when they will change. Currency forecasts compiled by Bloomberg see the rand averaging 15 per dollar in the second quarter. That too may be optimistic, especially if the commodity rally eases, according to Lars Macklin, a senior analyst at Danske Bank in Copenhagen. So the two main factors that they're looking at here is commodity prices as well as treasury yields. Macklin said the rand could weaken back to 17 per US dollar in a move driven by economic slowdown in Asia and positive US real 10-year yields or nominal yields above 2%. Now, I can agree with this back to 17 to some extent, as I alluded to earlier, that I believe we are now in wave 5, and after this wave 5 completing wave A, we should see a correction against this bigger trend. Whether this will be driven by economic slowdown in Asia, well, I think this is really wishful thinking. You can never really pinpoint what will be the main driver for exchange rates. And so let's just look at it now more holistically. Factors affecting exchange rates. And this list I have here is probably not even all of them. So we're looking at inflation rates, interest rates, country current accounts or balance of payments, government debt, terms of trade, political stability, bond treasury yields, import exports, commodities influence, speculation. Now the question is there an economic model that can factor in all these factors and assign the correct weights to each one of them? I will tell you now, as someone who's done econometrics and has done to some degree economics as well, it is impossible. So my advice, especially as someone who also trades currencies and speculates as well in the markets, find something that works for you, do your own research, and you can read the tweets and the articles, but don't take everything you read in the media as sacrosanct. Do not treat it as the Bible or it's the word of God, because it's not. Every analyst has got their own biases, they make their own assumptions, and even wealth managers like Magnus will try and drive their own agenda by tweeting certain things and not putting everything into full perspective. So yeah, that is the best advice I can give, is be able to filter what is truth or truth versus opinion, and most importantly, learn to make up your own mind. And that is it. Thanks for watching.